Hey everyone, and welcome back to the channel. Today, we're diving into an age-old rivalry that goes way beyond a taste test. Coca-Cola versus PepsiCo, but from an investor's perspective. We're breaking down their stock performance and strategies in 2025 to help you understand which consumer giant might be a better fit for your portfolio. Visual, animated graphic of Coca-Cola and PepsiCo logos clashing, then settling side by side with Stock Analysis 2025. Text, let's get into it. Section 1. The core difference: what they actually sell. First off, these two titans, while both starting in fizzy drinks, have become fundamentally different businesses. On-screen text, Coca-Cola. Pure beverage play. Coca-Cola, or KO on the stock market, has really sharpened its focus. They're a Total Beverage Company. Think about it, they mostly make the syrup concentrate, and then franchise partners handle all the heavy lifting like bottling, distribution, and logistics. This means Coca-Cola runs a very lean, high-margin business model. On-screen text, PepsiCo. Beverages and snacks empire. PepsiCo, or PEP, on the other hand, went a different route. They aggressively diversified, and now, get this, more than half of their massive revenue comes from snacks and food, primarily through their Frito-Lay division. Think Doritos and Lay's. Because they own the whole process for snacks, from manufacturing to getting them on the shelf, their total revenue is almost double Coca-Cola's. Visual, simple bar chart showing PepsiCo's revenue nearly double Coca-Cola's, but Coca-Cola's market cap is higher despite lower revenue. Maybe a pie chart showing PepsiCo's revenue split, 50% plus snacks, rest beverages. But here's the kicker. Even though PepsiCo brings in more cash, Coca-Cola has a much higher market valuation, over $335 billion compared to PepsiCo's roughly $205 billion. Why? Investors pay a premium for Coca-Cola's predictable cash flows and high profitability. PepsiCo is often seen as a value play, right now, trading at a discount. Section 2. Financials and growth. A look back and forward. Let's rewind 5 years. The COVID-19 pandemic hit Coca-Cola harder because its sales rely heavily on away-from-home channels like restaurants and stadiums. PepsiCo actually benefited from people staying home and munching on snacks. Visual, line graph showing Coca-Cola's revenue dip in 2020, while PepsiCo steadily increased. Then both showing recovery. In the recovery years, both companies showed strong pricing power, meaning they could raise prices. But here's an important insight. Most of their growth has been from charging more, not necessarily selling a lot more stuff. Sales volumes have actually stagnated or even slightly declined in some areas as consumers reacted to those price hikes. On-screen text, 2025 outlook, moderate growth. Shift from price hikes to volume and efficiency. Looking to 2025, the era of big price hikes is slowing down. Both companies are now focused on volume recovery and operational efficiency. PepsiCo, in particular, has seen a revised outlook to lower growth due to some challenges, including a major recall at its Quaker Foods division. Section 3. Profitability and efficiency. Who's leaner? This is where Coca-Cola's concentrate model really shines. Visual, bar chart comparing gross margin and operating margin. Coca-Cola is significantly higher in both. Coca-Cola's gross margin is about 61%, while PepsiCo's is around 54% because of those higher manufacturing costs for snacks. The difference is even starker in operating margins. Coca-Cola hits between 28% and 31%, while PepsiCo is only at 11% to 13%. Coca-Cola essentially acts as a powerful marketing and concentrate engine, with partners handling the capital-intensive bottling. This leads to an impressive 47% return on equity. On-screen text, PepsiCo's operational edge, negative cash conversion cycle, However, PepsiCo has its own efficiency superpower, its incredible supply chain and cash management. They have a negative cash conversion cycle of -12 days. What does that mean? They actually get paid by customers before they have to pay their suppliers. Coca-Cola takes about 16 days to complete that cycle. So, while PepsiCo has lower profit margins, it's incredibly efficient at managing its operational cash. Section 4. Dividends. Who pays more, and more reliably? Both Coca-Cola and PepsiCo are dividend kings, a super impressive title meaning they've increased their dividends for over 50 years. Visual, split screen with Dividend Kings badge on both logos. Table comparing dividend yield, 5-year growth, and cash flow payout ratio. For income investors, PepsiCo currently offers a more attractive dividend yield, around 3.7% to 3.9%, compared to Coca-Cola's 2.9%. Now, a quick note on payout ratios. PepsiCo's GAAP payout ratio looks really high, even over 100% sometimes. But analysts say this is distorted by one-time accounting write-offs. When you look at operating cash flow, PepsiCo uses only about 36% of its cash for dividends, giving it more room for future increases, compared to Coca-Cola's 60%. And for growth, PepsiCo has increased its payouts by almost 49% over the last 5 years, easily beating inflation. Coca-Cola's dividend growth was about 24% in the same period, slightly lagging inflation. So, PepsiCo shareholders have seen their purchasing power actually increase. Section 5. Global markets and new challenges. Coca-Cola still dominates the global non-alcoholic beverage market with about 40% share, followed by PepsiCo at 30%. The big growth engines for both are emerging markets like India and China. Visual, world map highlighting India and China. In India, Coca-Cola has a massive 56% market share in fizzy drinks. PepsiCo is at 34%, but saw double-digit growth in both beverages and snacks in 2024. Considering India's per capita consumption is very low compared to the US, there's huge potential there. On-screen text, China, local competition and health trends. China is a tougher battleground, with local brands like Yuanqi Forest gaining ground with sugar-free, health-oriented products. Both U.S. giants are responding by focusing on premiumization and functional drinks. Visual, image of Ozempic/Wegovy. Text overlay. GLP-1 drugs equals reduced spending on snacks and sugary drinks. And here's a major new macroeconomic risk. GLP-1 weight loss drugs like Ozempic and Wegovy. Studies show users reduce grocery spending by 11% on average, heavily impacting high-calorie snacks and sugary drinks. Since PepsiCo relies more on impulse buy salty snacks, it's seen as potentially more vulnerable than Coca-Cola. Both companies are adapting fast. PepsiCo acquired Poppi, a prebiotic soda, and is launching Doritos Protein. Coca-Cola is pushing Coke Zero Sugar, which saw 14% growth in 2024. Section 6. PepsiCo's big overhaul. Elliott Management. PepsiCo is currently undergoing a massive restructuring, partly due to pressure from activist investor Elliott Management. Visual, text overlay. PepsiCo's 2026 restructuring program. Bullet points: SKU reduction, cost cutting, targeted price cuts, workforce reductions. They're eliminating nearly 20% of their product varieties in the U.S. to reduce complexity, closing manufacturing plants, cutting jobs, and even planning targeted price cuts to stimulate buying and counter accusations of greedflation. This addition through subtraction strategy aims to boost PepsiCo's operating margins and get it back to solid organic growth. This is a crucial turnaround story for PepsiCo. Coca-Cola, having done similar streamlining in the past, has a more stable strategy. Section 7. Financial stability and forecasts. Looking at their balance sheets, Coca-Cola has a slightly stronger profile with lower debt and better liquidity ratios. PepsiCo's negative working capital isn't a weakness. It's a testament to its efficient cash cycle, meaning they use suppliers' funds to operate. Visual. Simple bar chart comparing debt-to-equity ratio. PepsiCo higher. For 2026, analysts are cautiously optimistic. While Coca-Cola is trading at a premium valuation, many see greater upside potential in PepsiCo because of its lower current valuation and the ongoing restructuring. Analysts like J.P. Morgan and Goldman Sachs have overweight or buy ratings on PepsiCo with higher implied upside than for Coca-Cola, which is expected to deliver stable, moderate growth. Visual. Table showing analyst recommendations and price targets for both stocks, highlighting PepsiCo's higher implied upside. Conclusion. Your investment choice. So what does this all mean? The battle between Coca-Cola and PepsiCo is no longer just about two identical soft drink companies. It's a choice between two distinct investment styles. Visual. Two distinct paths converging into a question mark. One path labeled defensive quality, Coca-Cola, the other diversified growth and turnaround, PepsiCo. Coca-Cola remains the epitome of defensive quality. It's a highly efficient cash flow machine with exceptional margins and a dominant position in beverages globally. It's a safe haven in volatile markets, even if its dividend growth has slowed a bit recently. PepsiCo represents a diversified growth platform currently in a critical phase of self-correction. For investors, it offers a more attractive dividend yield and, thanks to its lower valuation and the ongoing restructuring efforts, significant potential for a stock re-rating once its operational efficiency improves. Both companies are resilient giants adapting to new health trends and market challenges, whether it's local competition in China or the impact of weight loss drugs. They're investing in functional drinks and healthier alternatives to stay dominant. Ultimately, the choice comes down to your investment goals. Do you prefer the stable, premium quality of Coca-Cola, or are you looking for the potential upside and higher dividend yield of a re-energized PepsiCo? Visual. Final screen with both logos side by side. Text. Which one fits your portfolio? Let us know in the comments. Let us know your thoughts in the comments below. Don't forget to like this video and subscribe for more insights. Thanks for watching.